Financial assessment has arrived. Welcome to the Industry Leader Update, brought to you by Reverse Focus. The long anticipated, or dreaded, depending on your viewpoint, financial assessment was announced last week by HUD at the annual National Reverse Mortgage Lenders Association conference in Florida. The new guidelines will not go into effect until March 2nd, 2015. In fact, we'll be hosting a national webinar training session today at 11 a.m. Pacific or 2 p.m. Eastern. Just click on the banner below to register and join us today. The FA, or financial assessment, will measure both the borrower's willingness and capacity or ability to meet their financial and HECM obligations. The agency's introductory comments reveal the motive behind this new protocol. In conducting this financial assessment, mortgagees must take into consideration that some mortgagors seek a HECM due to financial difficulties, which may be reflected in a mortgagor's credit report and/or property charge history. The mortgagee must also consider to what extent the proceeds of the HECM could provide a solution to any such financial difficulties. In other words, HUD and FHA are seeking to move the product away from those who would use a HECM as a stopgap measure for long-lasting financial issues, which may resurface in the future, possibly leading to a default and displacement from the home. Now, having personally reviewed all 80-plus pages of the assessment guidelines, the new tool actually strives to qualify some problematic borrowers through a number of means, including extenuating circumstances, compensating factors, and the consideration of any eliminated existing mortgage payment obligations with the HECM. In its basic form, the financial assessment has three phases: documentation, assessment, and outcome. The documentation phase will require more time on both part of the originator and underwriters alike, thus lengthening the time required to close a HECM loan. The assessment phase, while ultimately conducted by underwriters, can actually be anticipated by the loan officer utilizing the worksheet which is provided by FHA in their documentation letter. Now, the worst case scenario is the requirement of a LISA, or lifetime expectancy set-aside account, to fund future property obligations, or the rejection of the loan outright. Overall satisfactory credit is defined as those who have made housing or mortgage payments on time in the last 12 months and have no more than 2 30-day late payments on housing, mortgage, or installment debt in the last year, and no major derogatory credit issues in the last 12 months. The assessment counts not only direct sources of income, but factors in the possible liquidation of retirement and savings accounts, which count toward the borrower's overall financial capacity. As an industry, it will be imperative to approach new prospects in a positive manner, or risk turning away potentially qualified borrowers. We are mortgage originators, and mortgages by their nature seek to manage and reduce the risk of default. Now, historically, the HECM program has been merely based on a borrower's age and home value. Today, that has changed as we more closely mirror our traditional mortgage counterpart. Now, what are your thoughts on the newly released financial assessment? Please share your comments in the comment section below, and have a great week.